Hello, this is Martin from seekedge, the channel for learning about trading and investment. Welcome to Option Trading for Beginners series, and today we are going to look at neutral non-directional strategies, and we are going to learn what exactly is an iron condor option strategy. So without much delay, let's get into that. So we are talking about neutral and we're talking about risk defined. So what is exactly neutral? And neutral is nothing but a non-directional strategy. Directional we had seen in the previous spread videos that we had seen. We learned about direction. We would have a view that the market would go in particular direction, either bullish or bearish, and how to deal with that. That is what directional is. Non-directional is we don't know how the market is going to move. It could be either way. All we know that the market may be moving in a particular range that we know about. Such strategies, such kind of view, how it can be traded is what neutral option strategy is all about. It is always neutral would expect that it would be a narrow range mount. It would be the price movement would be happening in a range, within a price range, say 15,500 to 15,900, or any particular range that we come to conclusion is what a neutral view would be like, right? So non-direction always will have a better win rate percentage. If you 50 to 65 70 kind of percentage of win rate will be there as compared to a trend following strategies. Again, the drawdowns also will be less, but return of investment per trade may be maybe less. If you look at one lot, how much is the return as compared to a trend following, it will be less, but you will consistently have more probable trades that will give you returns, right? And also when you have non-directional option strategy that is used with hedges, then you will get a very good margin benefit also, as against non-directional without any hedges, right? So we'll look at all this later. Now risk defined, we already know. What do we mean by so we're going to learn iron condor today. So iron condor is nothing but a risk defined strategy plus a non-directional strategy. It's a combination of both. So risk defined, we already seen that it will return the return of the investment of is known to us before we take the trade. It's not something that we keep changing or something that we discover, right? It's something that we know this is going to be the max loss, this is going to be the max profit. All these details are known to us, just like when we take any risk defined strategy, like what we had seen earlier, the bearish and the bull splits, also we had the same. So the break even, the upper break even and the lower break even, the break even points are known to us. What is the probability of win for the strategy is known to us, right? What is the maximum loss that can happen is known to us. What margin capital requirement may be there, may be required. All these things are known to us. That is why it is known as risk defined. Let's proceed further. So when we talk about neutral option strategy that we're going to learn, what we're going to today look at is iron condor only. But iron butterfly is almost almost the same strategy. Once you know iron condor, iron butterfly is just you don't have to learn much on that. Now straddle and strangle are also if you know iron condor, straddle and strangle are easy, but the only difference would be that straddle strangle would have between iron condor and iron butterfly is that straddle strangles would not have hedge positions, otherwise it's the same. So these are the uh, scope of our discussion today. The iron condor, what we are going to learn in this particular video is it's nothing but an extension of what we already learned in the previous. So it's a bull put spread and a bear call spread. Now we had seen, so if you combine these two, it becomes an iron condor, right? In one of the strategies, we know both of bullish and bearish spreads that we had learned. We've seen that in case it is a credit strategy that we are using, there is a chance that we can convert that into a iron condor as part of an adjustment of a spread. So that's exactly what we're going to do. How do you create a there is a mistake here, it's not a spread. So the iron condor construction is by selling an OTM put and by buying an OTM put first, and there is a lower strike. The second, the buying is at a lower strike. Then again you sell an OTM call, right, and you buy an OTM call which is at a higher strike than the sold call. So this is how you construct the iron condor, right? ATM OTM details we already know. So the payoff charts will be looking something like this, right? We have the sell, we will be shorting the call and a put and a call, and then we'll be taking hedge positions on either side. both call side and put side also, right? So the risk defined parameters are are all defined here. Probability of profit for this particular, for example, just for example sake, it is put, it is much less. It is having near to 42%. Maximum profit is 2000 and maximum loss. So the risk reward is almost the same, 1:1 point something. Break evens are, yeah, as long as it, the price movements remain between 15,450 and 5950, then we are safe. So this is a credit strategy, so we're getting credit of plus 827 rupees. The margin is very low, very low margin requirement is around 37,000. Is maybe slightly changing here and there, but that is what approximate margin requirements. So the payoff diagram will tell us what is the range, what are the risk defined parameters, and what are the premiums, and then all these details, right? This can be seen from any of the tools or in the Excel sheet also. You can, based on the formulas that we'll be discussing in the next slides, we can create your own. But tools like Sensible and Opstra has got all these details ready-made. We'll see how it can be constructed in one of those tools also later. Now the maximum profit and the maximum loss and the break-even point. These are the three break-even point. These are the 3 points that we need to understand whenever we are taking any strategies. This should be in our mind. What is the maximum I can lose? What is the maximum I can get? Why do I need to know maximum I can lose? Because I need to have a plan on when I have to exit. So unless I know what is the maximum loss, I can't, right? Similarly, I need to have a plan when I have to exit, when I am in profit. So I need to know maximum potential of that, and the certain percentage of that I will exit, right? Break-even point is where I decide when I have to adjust. So adjustment is, if you are doing the adjustment, the break-even points need to be known. If you're putting a stop loss or if you're exiting, you need to know what is the maximum loss and maximum profit. So this is how you derive basically. The maximum profit is nothing but the difference, the net premium into lot size. It's very easy. Net premium is what, like, so you can see that 5900 call is costing 93, 15500 call is costing 96, right? So those are the two. So some of that will come to somewhere near 200. Similarly, what we have bought. So what you have bought is 71 rupees for 15400 and 16,000 for 61 premium, right? So that two you combine means it will come to 130 rupees something, right? So the difference between 130 and 200, somewhere 50 rupees or something it may come, right? That multiplied by the 50 lot size, right? That is going to be, so that is how it is calculated, right? So what credit that you are paying is on the top. All the short positions premiums, if you collect together, subtract from the short position, subtract the what you paid, what you received premium and what you paid premium. The difference between that two is what premium is, what the maximum profit for it. So that is exactly what you are seeing as 2000 rupees. That is multiplied by lot size, you get the rupees. The maximum loss, you can see that it is you have to subtract that amount of the premium that you are receiving, right? You have to subtract that from the difference between the strike price. That means, so difference between the long call and the short call. So right, so what we are shorting here is 15,500 and here is 400, that is 100 minus the premium difference and 50 into 50, that is what 2,500, somewhere that range is coming, right? So that is how we calculate the maximum loss. Then commissions also has to be subtracted to get the exact loss, right? Here the commission may not be considered in the payoff chart that we see in this now, but you'll have to subtract that also because that is all paying out. So net received minus net we are paying out, including brokerages, as well as for buying that buy legs, what is the hedge positions, what much you are paying. So the difference would be what we are losing in case we lose, right? Upper break even is also calculated similarly, right? So upper break even, so here it is 15, the strike price is 15,500, right? So net premium is 15, means you have to subtract 15,500 minus net premium 15, 450 will come. Similarly this side, what is the break even point? That is 15,900 minus what is the net premium that we are paying, 50 rupees. So 900, 850, somewhere in that range will come. 950 you have to add here 950, right? Call side you have to add the difference between the short strike subtracted by the premium. Here also short strike so on the put side it is short strike subtract the premium. Here short strike add the premium. That's what you say. That is how we find the break even. You can see that the break even is coming 950. That is 900 short strike plus 50 premium. Here also 15500 short strike plus premium minus premium is 450. 500 minus 15500 minus 50 is equal to 15450. Right. That is how approximately that's how you calculate the lower break even in the higher side. So let's move ahead. Now we talked about support. So how do we come to this price point? That is a big question, right? How do we know that we have to sell 5900 and 15500, right? So that depends on, right, what is your view. No, your view cannot be directional, right? Your view cannot say that it is going up and it is going down. No. So in case of neutral strategies, your view would be range bound, right? You would expect the market to move from 16,000 to 15. 450. That may be your view. That is why you have taken the strike, right? So that we can get from the technical analysis. There are different methods can be used. For example, ICICI banks, we have a view that we take before we take the encounter that the market is not, the ICICI bank stock is not going to go below 600 and above 670. So we are expecting the market to be there range bound during the expiry for which you are taking the trade. So here the previous support and resistance are used. Now if you are well versed in technical analysis, you can use different techniques. You can use different indicators, you can use Fibonacci retracement, you can use pivots. So any technical analysis can be applied here too. But the ultimate aim is to come out with a view of a range of the expected price movement, because based on that is where you decide what are the short points. Where do we need to short, right? So once we derive our upper and break even is where we short, and then you will hedge it at a strike that is at the break even. So here I found that I am having a belief that it will not go above 15900. I am of a belief that it will not go above 15, not go below 15500. Right? I sell at both the points, call and put, and then I hedge it on both sides with a break even point. Break even is, we already found how we can calculate, right? 15500 minus the premium 50 rupees, 15900 minus 50 plus 50, that is 15950. So that is how you derive at the support and resistance and then derive at the strike places. So when do we use the IRONCONDOR, right? Yeah, so first of all you should have a neutral view, right? So you should not be bullish view means you should not take this strategy. Your view should be that you don't know, you don't care whether it moves up or down, but you care only as long as it is in a range that you understood from the technical analysis, right? So the price is not expected to move significantly. If you see the charts and you are seeing that there is a trending move, up move that is happening, some breakout is happening, don't trade that, right? Only if you see that it is within a range like we saw in the previous chart, and only if you see sure that it is consolidating should we take this strategy. Also the volatility level, the VIX India the implied volatility level also you have to check whether it is a low volatility is where it best performs, right? And also the stocks, if you are taking, it has to be a volatile stock. It should not be a debt not moving kind of stocks. It should have liquidity also, right? Bid ask spread you have to check, then it's fine. So this is the situation for the IRONCONDOR will work. Now how do we enter and how do we exit? Now the entry, as we already said, enter when the price is between the support and the resistance levels, right? Now if you have a view at that the price will not move and then you are taking the position after the price will move, no point. So it should be anywhere between the support and the resistance level that you have studied. Now if there is a significant movement, we already discussed that, right? You should not take that. Any trending or we expect the market to consolidate and not move up. If you are expecting to move up, go for bullish view, don't go for neutral view, right? Now days to expiry is very important. We already seen. So you have to take this position before this beginning of the first half of the expiry, monthly or weekly, wherever it is. It has to be in the beginning. You should have sufficient time to do adjustments, and you should have premiums for that. If you don't have premiums, you can't adjust. Now also you should exit before the end of the expiry, few days. Monthly means last week you should not trade. This before that you should have come out. And weekly means you should come out on Wednesday at least. Now The target should not be kept for long. You should have 30 to 50%, then you have to come out. Don't wait for the maximum profit to happen. Never happens, right? So book the profit the moment you get it. You get 50% of the max profit that you already calculated, right? Also book the loss whenever it goes 50% less than that. So adjustment is not mandatory, but if you feel that there is sufficient time and left for the expiry, then only adjust. And it has to be done when before the break-even point is breached. Break-even point we already seen, right? Either side, upper or lower. Before that happens, you do it. Now, low volatility is very important. When there is high volatility, or do not trade high volatility stocks. When or the IV is very high, do not trade. But there should be minimum volatility has to be there, just less than 1.2 in the case of stocks. Now it has to be liquid stocks. We already seen these 2 points in the previous slide also. Let's move ahead. Now adjustment, we'll come out with the adjustment detailed sessions later, but essentially adjustments can be first thing is adjustment is not a mandatory thing, right? Adjustment is to come out from a loss. That is the primary purpose, to increase the probability of your winning and come out with the break even or reduce your loss. This is what you have to look at it, right? So sit tight if it is going fine, right? That is one strategy. That itself is a strategy. Now if you are adjusting, then there are different ways of adjusting, right? You can look at the delta value. Delta is the Greek, which indicates how much of price movement can happen. For every spot price movement, how much of price movement in the option can happen is what delta. That comes in a decimal value. You can see it in any of the tools. So if the delta, you take the position when it is a delta is at 0, and then if it moves further towards 0.25, 0.3, either side, minus 0.25 or 0.3 or plus, either way, then immediately you do the adjustments. All right, you do the adjustments would mean that the tested side, untested side only we would be squaring off, and then shift the position to a strike with better premiums, right? And the tested side we will not touch, right? So we keep on moving the untested side will be always giving us a profit. Tested means what? Tested means the side that is going against you, the expectancy, so this is the range. The range is 15,500 to 15,900, right? 15,900 is the call side and 15,500 is the put side. So it is expected that the market, so if the market is the expiry is closing with a price range in between these two values, things you get the 100% credit. Subtract the premium that you paid, get the full premium that you are received, right? That's how it is. So the moment the market moves away from 0 delta, or from so delta also increases this side and that side from the neutral 0, right? As you go further up, it will keep on increasing. If you go further down, it will keep on increasing on the negative side, put side also. So if it is moving certain delta, then what you need to do is this side you have to book profit. This will be profitable. The left side will be profitable. The put side will be profitable, and call side will be in loss if it is moving towards the call. So book that profit side. Book that profit side means both the legs, right? Both the legs is what? The 15,400 put and the 15,500 put. Both you have to score off. So you will be in profit only, because when this is falling, this will be profitable. Left side will be profitable. And then you take a strike which is further. If it is 15,500, take a 15,600. And similarly, if it is 400 means 15,500 put hedge, 500 buy you do. So 15,500 buy and 15,600 sell. If you do, you have done an adjustment of. You shifted the strikes, and it changed. It became another IRONCONDOR, but one of the leg of that is cut off and a new leg has come in. That's what I was doing. Similarly, if the market is moving towards the put side, the call side would be profitable, and the call side you have to shift. That is 15,500 can be shifted to a 15,400 will have better premium. Similarly, the buy will be 15. If the buy position is at 16,000 means you move that further to 59.50, right? So that is known as the rolling up and rolling down. So this rolling up and rolling down adjustment or shifting of the legs can be done based on the price movements on either side. It can be done based on the premiums, can be done based on the delta, can be done different ways. That's what you are looking at. So here we are seeing that delta is one way. Premium, if you buy a leg of you short two legs, both have premium of 25 or 25 each, or somewhere in that range. So whenever there is an imbalance, one becomes 25 premium and other one becomes 15 premium, then you adjust. Or you can say the strike price is 15,000, was taken when it was just 15,700. The price moved to 15,800. That means 100-point movement, adjust, or 100-point movement backwards. Price was taken as 15,700 and it became 15,650, then adjust. So it can be strike based, it can be premium based, it can be delta based, right? And so basically these are all different. Or we can do, what we can do is don't do anything until the break-even point is reached. So few points away from the break-even on either side. Break-even we are already understood, when it is break. Few points before that you adjust, but sometimes it will be too late. That's why people go for the premium or price or delta. So we'll study further in details on all of this. It's not very complicated. Only thing is you have to get used to execution of that very fast. Like you just have to cut off one leg and then buy both has to happen simultaneously in a very short span whenever the market is firing up, right? So if you wait for the breach of the break-even to happen, after it has happened, there is no point in adjusting. You will never be able to firefight and bring it to profitable. So this is what IRONCONDOR adjustment is all about. Now again, coming back to the general rules of any option trading, if you have already seen the previous videos, then this will be the repetition, but this is the core, this is the crux of any option strategy trading. So you should have a view. Already seen, the view should be very clear, whether it is range bound, bullish, bearish, whatever it is, it has to be very clear. Here also the same, your view should be correct on the technical analysis. Then the days to expire is very important. We have seen that, right? Adjustment is not just for the sake of adjust. Don't simply adjust, because you will pay brokerages for every adjustment. Every time you close a position, you will be paying for that. So be careful on that, and always cut the losses and exit early, right? If it is less than more than 50% loss, get out. You can always take another one, right? And also you have to practice the execution of these trades by taking multiple IRONCONDOR strategies over multiple weeks and multiple months. Then only you will get to know how exactly the delta has to be identified, what premiums I should exit, and what tricks has to be used in adjustment. Many things are learned by practicing that, right? So never wait for the last week. We already seen that whenever it is 30 to 50%, book and come out, right? And you'll take a new position. And putting stop losses or exiting one of the legs may not work, because the market can change its direction anytime. It may go and you reach your break even and then go further down and then reverse and come to your delta neutral position again, all in a matter of few hours. So all these things are V-shaped recoveries are very common nowadays. So putting stop loss would only so when you have a hedged position, just like spreads also, here you are hedged. You know what is the maximum loss. When that is either you exit as per your rules, right? It's the best option. Exit as per the profit target, the loss target, or adjust it before it is breaching, right? So that is what. So do not wait till the gamma move happens. You already seen that. Now position sizing has to be always individual basis. If you have only couple of lakhs, then take one lot and trade that. If you have more money, take two lots. So every lot size you increment and trade, your psychology should get used to the wins, the losses, the mark to market, and all this. So it takes time, and you may be applying the same trick, but when the mark to market figures are huge, if you're making too much money or you're losing too much money, both way your psychology will be impacted. So you have to get used to certain lot sizes before you move to a higher lot size, and all lot sizes has to be purely based on what is your total capital, right? You should not take any trade where you put all your capital. Every trade should have only certain percentage of what your total capital is. That means at least if you have only 5 lakhs, then can only so position sizing is very critical, right? And do not over leverage also. So just because you are getting the hedge benefits and margin benefit, if you take more lots based on that, then it will not match if there is a big loss that is going to happen, you know, continuously for 2-3 weeks. Then your portions, your capital, you know, ruin will happen. So you have to be careful on that. Now that is all, you know, from the presentation point of view, the conceptually what Iron Condor is all about, right? So rest is all practice of adjustments and practice of entry, right time, exiting, booking, you know. So keep on practicing that, you master it. Now let us quickly try to create a Iron Condor from the tool of Upstart and see what happens, right? So we take the same position. This is the Upstart tool for strategy builder, and we're taking the same position in the nifty, right? We're going to take next week's position. Our range is 15,500, right? Put, we short it. Now the other side, our range is 15,900. So we short that call also. Then we take the hedge portions at 15,400. We are taking a put buy position and 15 and 100 points away, 6,600, which is a call, and we are buying that also. So here it becomes an Iron Condor. So what did we do? Our 15,500 and 15,900, right? Call side, put side, we sold it. Then we hedge it with the lower strike, 100 points difference between 500 and 100, and 100 points between difference between 15,900 and 16,000. So we bought that. So 2 buys. So these 2 buys are our premium paid, and these 2 sells are our premium received, right? So this is a weekly option. What is there in the screenshot is a monthly option, right? Now instead of the calculator, if you go, if you put the position here, only monthly strike details are, you can see I'm taking for the July 15,500, 15,900 with 2 hedge buys and 2 sells. So what is the margin that is coming to? It's only 35,500. So that's the same thing that we are seeing here also. Somewhere this is weekly, but it's more slightly, right? So monthly it comes to only that much to take this strategy. That does not mean that you can take multiple lots, right? You should take the lots depending on your capital percentage, right? But this is the cost that is coming. So if this is the weekly, right? So weekly we are seeing that your risk reward is almost is less, right? But your probability of win is more in this case, right? So this is all that right. This is all the demo on the Condor is all about, and that's a summary. So please leave your comment, feedback on how we can improve it further. Please subscribe and share with your friends and colleagues. Our subscriptions are very less, and therefore appreciate if you can help us get more subscriptions on our channel, so that we get motivated to to give you more valuable content further. Leave us your comments also, please, and thank you for watching, and happy learning and happy trading. Bye.